Radio Cayman everywhere.
Everywhere.
Can you hear me now? Everywhere. Everywhere.
Yes, right from your Android or iPhone. Download the Radio Cayman app now on your Android or iOS phone.
The Radio Cayman app
is where you can listen to Radio Cayman everywhere you go.
Everywhere we go, we go. Everywhere we go, we go.
Find it in the Google Store, the Apple Store, or use the link at www.radiocayman.gov.ky.
Yes, now you can listen to Radio Cayman everywhere.
Money Sense is brought to you by the Chamber Pension Plan. For further information, visit chamberpension.ky.
The Cayman Islands Chamber of Commerce Pension Plan is kicking off the new year with a new website to better serve our members and a new administrator's agent that will help fulfill our vision for your pension plan. Our website, chamberpension.ky, features improved web services like a real-time chat to help answer your questions quicker and audio tips to help you plan for your retirement savings arrangement. Our new administrator's agent, Saxon Administration Limited, will benefit members through enhanced systems and IT services, allowing for a greater customer service experience. The Cayman Islands Chamber of Commerce Pension Plan. We're here for you. If you would like to join or request further information, visit chamberpension.ky. And for information as it happens, follow us on Facebook, LinkedIn, or Instagram. Email admin@pensions.ky or call 745-7630.
Money Sense, bringing an informed financial perspective to the Cayman community.
The decade of the 2020s appeared to be inflationary. How should we allocate our investments? Welcome to Money Sense on Radio Cayman. We're broadcasting live from the studios today on 89.9 in Grand Cayman and 93.9 in Little Cayman and Cayman Brac. My name is Emil Kalinowski, and I am joined by a very, very, very special co-host, a professional gentleman of macroeconomics, Mr. Adam Butler. Welcome to the show.
Wow, that was quite an enthusiastic introduction. I appreciate it. It's very fun to be here. Excellent,
excellent. I will follow you around and I will introduce you wherever you go all day long. People should be introduced like they are on the radio. Anyhow, we don't have a lot of time, so let's jump into it. This was your baby, this idea that you want to talk about today. So it's an inflationary decade ahead. We're going to talk about what kinds of inflation there are and what kind of investments might react to those kind of inflations. So let me throw it over to you. What kind of inflations are there?
Yeah, great question. I mean, let's start with maybe a basic definition of what is inflation, because I mean it's maybe surprising to many listeners to know that actually there's no real consensus in the economic community about what the definition of inflation is, right? So let's just stipulate that inflation is the general rise in the price level, right? And how do we see that as general everyday folks? Well, we go into the grocery store and we notice that the shelves are, many of the shelves are empty. We can't get the broad selection of goods that we expected. Maybe there's a dearth of people working at Starbucks or working in the coffee shop or working at the pharmacy. And so the lines are a little bit longer. And also, of course, we see that prices have gone up, right? So you've probably noticed that prices have gone up for fruits and vegetables and meats and a lot of packaged goods. And so the question is, how does this inflation take place? Why does it happen, right? And there are three core dynamics that lead to inflation. One is a shock to supply. And typically this starts sort of narrow. And in this case, for example, in 2020 and early 2021, there was a major shock to lumber prices, right? And that impacted the cost of houses, and there was a dearth of availability for lumber, and lumber spiked by several 100% in a few weeks and months. And then it spread into the broader commodity complex. And so we had a spike in grains. We had a spike, obviously we're seeing a major spike in energy prices.
That's the classic example, the 1973 oil embargo. I'm thinking of supply shock inflation.
Absolutely. That's exactly right. Yeah. And I mean, obviously, we're seeing the same type of dynamics leading to an energy shock, inflationary energy shock as well this time, right? With the war in Ukraine. Importantly, though, the conditions were already in place for a major supply shock in energy. And the reason for that well, there's many reasons for that, but a major reason for that is that I think the developed West, in their ambitions to meet their climate objectives, were optimistic about the ability for sustainable and renewable sources of energy to be able to take over for traditional carbon-based energy sources like coal and oil and natural gas much more quickly than actually came about. And so there was a systematic underinvestment in conventional energy sources for the last decade. And what that means is we can't bring on new energy sources nearly as quickly or in the volume that's needed in order to supply the global economy. And of course,
it makes me think of that relay race we used to run when we were young, running around the track, and you're handing off the baton to the person, and that person's supposed to grab the baton and run, except we stopped short and we're sort of throwing the baton, the energy transition baton. Oh, it's too dirty. I'm not going to go over there. And I guess that would make sense if you could pick up the baton. I'm torturing this analogy, but the point is, that's what happened. That's what you're saying. We didn't make the transition cleanly. And we were underinvesting. We were too optimistic that it was just going to go off so simply. And now we have a problem, one of many probably, that we're going to be facing in the energy world. Okay, so we've got supply shocks. Are there other kinds of inflation?
yeah, I mean, one critical piece of the puzzle at the moment is demand-led inflation.
Mm-hmm.
Right? And what we saw in March 2020 in response to this major global COVID pandemic is that governments around the world, in an effort to provide people with money while they were locked in their homes so that they could buy their basic necessities, they deposited money directly in people's checking accounts. And what that means is that these people now have, and especially people in the lower income brackets, now have a much larger amount of spending capacity than they did before. And they went out and they bought stuff. They replaced dishwashers and they replaced washers and dryers, and they bought new toasters and blenders, and they paid down credit card debt.
Is this the right way of thinking of it? It's not so much the money that was given, fine, yes, but the demand shock is we went from a world where consumption was split between services and goods, because we went out to restaurants or movie theaters, or we booked consultants, and we also bought goods, to a world where we were in a lockdown and no services consumption was allowed to take place. So there was a demand shock for goods demand. That's the way I'm thinking about it. Is that a good way of thinking of it? Like all of a sudden, no services consumption, only goods consumption.
Yeah, I think that was a really major contributor.
Okay.
And I think over the last year or so, that has now transitioned into the service sector. And how does that happen? Well, there's a lack of available supply of labor. And, you know, one of the reasons maybe why there is a lack of available supply of labor, especially at the low end, is that the low end of the income spectrum is now flush with cash. And so they're not as desperate to go out and get the jobs, which maybe are less palatable. And so it's just a little bit harder to find. And we see this all over the world. We see it on island here, right? It's very hard to staff hotels, restaurants, et cetera, with experienced personnel. But this translates to what they're seeing in the U.S. and Canada and Europe and in other parts of the world.
I'd like to also suggest that employers are not paying enough. And that's another reason why many employees do not feel it's worth it for the level or stress or danger in some jobs to take on these jobs. I've seen anecdotal reports about this. I don't know if there's a study of it, but that's at least my going worldview, is that employers don't feel that they can then pass on these costs to the consumers, the purchasers, their eventual customers. But okay, so labor shortage, but let's not get too off topic. We were talking about demand shocks, supply shocks, check. Demand shocks, did we cover that? Is there another kind of inflation that we want to talk about?
Yeah, so there's monetary inflation, and I think you may actually be the better one to sort of lay out the framework for monetary inflation.
What a perfect handoff of the baton. Very good, Adam. See, this is how the people in charge should have done it with the energy transition. Well, Adam, believe it or not, I am one of those disturbed people that believes that inflation, as it's originally defined, is only monetary, because inflation is not the same thing as a consumer price increase. A consumer price increase can be brought about by what you just said, supply and demand shocks. But inflation is a persistent and pervasive global, all across the economy, increase in the price of goods. Now, some people may be saying, wow, 6 of one and half a dozen of the other, what's the difference? But it's important to realize where this source of inflation is coming from. Supply shocks, demand shocks versus monetary inflation. So monetary inflation is the preponderance, the multiplication, the overwhelming surge of a tide of money washing over the economy, flooding everything. Where does that money come from? It could come from the government giving out stimulus checks like they did in the United States, or in Europe, furlough payments, never-ending furlough payments, universal basic income, that sort of tax rebates that are never-ending. But in the United States, I would say they haven't been persistent enough to my liking for it to be overwhelming monetary inflation. You know, in the United States, they gave out 3 stimulus checks, and that's it. I would expect it to be every month, that sort of a thing. I guess that's universal basic income. The other place that monetary inflation can come from would be private banks extending loans to the economy, to private businesses and households. And there are good people that could disagree on this topic, but there are some people that say that also central bank creation of quantitative easing is inflationary, and expansion of the monetary base. We don't have time to get into it, but I disagree, and I point to the last 20 years where inflation was low and quantitative easing was off the charts, central bank activity was high. That's non-economic money. It is a kind of money, but it's a very narrow money that's only used by a specific set of economic actors, banks. And if those banks don't want to extend it throughout the rest of the economy, it's not taking place. But the point is, we've seen those stimulus checks. Now we're in another downturn. Maybe they'll keep coming. Maybe universal basic income, maybe helicopter money, maybe government guaranteed private bank loans. I kind of messed that up, but I'm trying to say a bank extends a loan to a household or a business, and that loan is guaranteed by the government. We're seeing that right now. The United Kingdom just announced that they will guarantee a 5-year loan to Jaguar, which I'm all for. They're lovely cars. Anyways, and then France has just announced that they're going to extend those kind of government guaranteed loans that they implemented during COVID, and they're going to bring them back because of downturns. So, all of which is to say those are different kinds of inflations. And we're in agreement. Are we in agreement, Adam? I don't know. That this decade ahead of us will be inflationary.
Yeah,
we are?
I mean, I think I certainly agree that we're going to see a higher average level of inflation over the next decade for some of the reasons that we've had a chance to discuss, and a variety of other reasons that we haven't. What's interesting, too, is that typically, if you go back historically and look at other periods of sustained inflation, it's not as though there's, you move from a low inflation period to a high inflation period, and then you get consistent quarterly or monthly inflation prints that are at the same level. What happens historically is that inflation happens. This is uncomfortable for global governments or global central banks, and then they introduce policies to manage through those challenges, because typically constituents of countries don't like inflation. It's an unpopular thing to have happen to them. They don't like to see the prices of the things that they're buying going up faster than their wages, for example. And so governments intervene. And what ends up happening is you get shocks in inflation that lead to big surprises on the upside, government policy interventions, and then major price controls. Exactly. Ugh. And then you get a decline in inflation at the same time, but often you get a decline in growth. And so you get this inflation volatility. So it's not as though you can just go out and buy certain types of assets and expect them to always work through this period. It requires a more thoughtful, nimble approach to manage through an inflationary decade. And so I think in the next segment, we're going to want to talk about how to approach that problem.
Fantastic, Adam. You're a professional at this. You're throwing it to me to
like
throw to the commercial. This is only your second time, though, isn't it?
Yeah.
Fantastic. Ladies and gentlemen, the second half of the show is going to be packed. Don't go anywhere. We're going to commercial right now. Come on right back.
As the longest established pensions plan in the Cayman Islands, the Chamber Pension Plan looks forward to delivering the same strong performance for our members, but now in a new location. As of March 1st, our new pensions operation office is located at 14 Saturn Close, Eastern Avenue, the same building as our new administrator's agent, Saxon Administration Limited. A dedicated and experienced team will be assigned to the Chamber Pension Plan. If you would like to join or request further information, visit chamberpension.ky. And for information as it happens, follow us on Facebook, LinkedIn, or Instagram. Email admin@pensions.ky or call 745-7630. The Cayman Islands Chamber of Commerce Pension Plan. New location, new administrator's agent, new customer service, same strong performance.
This is
Money Sense, bringing an informed financial perspective to the Cayman community. Brought to you by the CFA Society Cayman Islands.
And now, more Money Sense.
Welcome back to Money Sense. My name's Emil Kalinowski. Did you know that you can also watch this radio show? Yes, you can. Go to YouTube, go to the Radio Cayman webpage channel, and then you will be able to see us. You don't want to see me. You want to see Mr. Adam Butler, who is doing absolutely fantastic job telling us about the inflationary decade ahead and what kind of investments we can think about. Adam, where did you come from? You're like a radio professional. What do you do? Tell us very quickly, and then we're going to talk about the rest of your ideas.
Yeah, no problem. So I'm the Chief Investment Officer at Resolve Asset Management Global, and we manage hedge funds and mutual funds that are listed in Canada and the United States and overseas. And our strategies are what we call systematic global macro or macro trading, which means that we trade, dozens of markets across equity indices, bond indices, commodities, currencies, long and short. And it's specifically really designed for markets where it's very hard to know where to invest your sort of conventional money. So it's meant to be sort of complementary to traditional portfolios.
A professional gentleman of macroeconomics. Fantastic. I love it. Okay, I'm throwing it back to you because we don't have enough time to talk about all your excellent ideas. So what did you want to talk about right now?
I want to talk about how to position for an environment that is likely to be a lot more confusing than the decade that we've just left, right? The decade that we just left.
And the decade we just left wasn't very straightforward either. Yeah. So it's going to be even more confusing. All right, go ahead. Go.
Well, yeah, the sort of period from, let's say, kind of 2010 to 2019 was relatively stable. If you look back through market history, that was a really easy decade to just kind of do the simplest thing possible. Put it into global equity indices and bond indices, your typical kind of 60-40 stock bond portfolio. The last decade was perfectly designed for that portfolio to do well.
Well, that's just going to continue forever.
Yeah, so history would argue with that, right? And I know you're being ironic. But typically what we see, if you go back 100 years or several hundred years, is that we go through 10 or 15-year periods that are really good for traditional portfolios of stocks and bonds. And that follows other periods where stocks and bonds just kind of tread water after inflationary terms for the next few years. And I think what we're coming into now is one of those tread water phases for stocks and bonds, which means you've got to kind of think outside the box.
Instead of setting it and forgetting it, like Mr. Ron Popeil, for anyone who's in their middle age, and none of the kids know what we're talking about, set it and forget it. That's the passive investment strategy. Right now we need active. Right? That's what I'm thinking. I definitely think that's the decade ahead, is the doing it the way we were doing it. I doubt it's going to work this coming decade.
Yeah.
So there are different kinds of inflation. So should we consider different sort of responses to each specific kind of inflation, broadly speaking?
I think so. Yeah. I mean, in a supply shock type of dynamic, typically that happens in the commodity sector. And when there's a shock to the supply of a commodity, typically those commodities are essential for the functioning of the economy. And so the ability for the economy to moderate their demand for those commodities is very moderate. And so when there's a supply shock, those commodity prices typically spike. So for example, you go back to the 70s, you mentioned the oil embargo in 1973. Obviously that led to a massive supply shock for oil. And that transmitted through the entire economy because oil is used in virtually every industrial process and in many service segments of the economy as well. And that led to higher inflation expectations. And so commodities are a really good way to hedge a supply shock-led inflationary episode, right? So you want commodities to be available to you in your portfolio. What works in a demand shock? Well, typically a demand shock propagates through the entire economy. It propagates through services. It propagates through the cost of labor. And so really maybe the best hedge for that is inflation-linked securities. You look like you had something to say.
Well, I was thinking that I forgot to mention that there's a particular kind of supply shock that we may be all experiencing, but it's because it's glacial, we may not be noticing it, and that's deglobalization. And the world was built for an ever-increasing, ever-accelerating cross-border movement of people, goods, and money. And that meant just-in-time inventory, and that meant efficiency, focus on efficiency, not resiliency. Why would you focus on resiliency? We're all on the same team. We're all on Team Human. Well, that stopped around 2008, and it's only gotten worse. Global trade wars, tariffs, and now delinking countries from the financial system, and we can't take Russian goods. And I'm looking at China as potentially, and I'm sure China is also looking at themselves as potentially the next number in this queue of the West turning on some supplier because they don't particularly like the way they're governing their country. Fair enough, that's a political discussion for another time. But I'm worried about deglobalization. That'll lead to shocks. That'll lead to supply chain and logistical problems. But we have so much that we rely on in China for our goods. I'm thinking, what do you think of this, Adam? Old industrial sectors that are already built, that have the capacity, but are on the other side of the quote-unquote bamboo curtain. And I took that from Russell Napier. Forgive me if Russell's listening. That's his idea. The other side of the bamboo curtain, like South Korea or Japan. I don't have any specific names, but that's kind of what I was thinking. Industrial production, manufacturing on the Western team, quote-unquote. What do you think?
Yeah, I think that's a really astute observation. I think that...
Thank you.
South Korea and Japan have been on Team West for decades. They're committed partners. Japan is on the I-5 global security regime, so they are a member of the most tight-knit global security alliance with the U.S. and Europe, Australia, Canada, and Japan. And so they are a strategic global partner. And I think as tensions escalate between the West and China, that more manufacturing will migrate to South Korea and Japan, and I think that's a really good general direction to allocate funds.
So commodities, perhaps industrial manufacturing capacity that's already built on Team West. And for demand, what did you say for demand shocks?
Yeah, so maybe substituting some of the nominal bonds that most people typically hold in their portfolio for, typical Barclays aggregate or, broad-based bond funds. They don't typically hold much in the way of inflation-linked securities. So any way that you can migrate some of your fixed income holdings to inflation-linked bonds is another potential way to hedge against a certain type of inflation.
I love it. I feel like we should do a show at the end of the decade and see how our predictions turn out. I'm sure we will. Another investment possibility, hedging, would be for monetary inflation. Adam, is this a layup? Is this too easy?
I think you should go for it.
Should I be ashamed of myself for saying the 4-letter word?
I don't think so.
Gold.
Yes, sir.
Gold. It's a monetary metal, and it will return value if we experience monetary inflation. You think that's not unreasonable? And silver, if you want to get frisky, right? Silver does a little bit more or less, depending on the monetary disinflation or deflation or inflation circumstances. But gold and silver, in parentheses. What do you think?
I think that's absolutely right. I mean, what is happening with monetary inflation? Governments and or banks are creating more pieces of paper that they call money. And so they're able to do that at whatever rate they like. And on the other side of the coin, gold, the amount of gold that is extracted from the ground each year is a vanishingly small fraction of the total amount of gold that is held above ground. And so the supply of gold really doesn't change from year to year, whereas the supply of paper money changes at the whims of governments and banks. And so as we run the risk that governments may get a little bit overly ambitious in their stimulus efforts and to achieve their political goals, then I think gold's a really good potential hedge for people to hold in portfolios.
What about this geopolitical idea? Recently, the Team West announced that they don't care for Russian reserves anymore, and that they will no longer allow Russia to move its funds around too easily, and that reserves will be frozen, and that if you're a Russian bank or person or whatever, well, we don't really want to participate with you. That's the message. Maybe there's some nuance to that. But that's the big message that came across from Team West, and we've seen it happen before with Iran. What do you think? I think that's quite provocative, especially freezing of central bank reserves. I know that this happened to Venezuela with Britain, who seized Venezuela's gold because they didn't care for the cut of Mr. Maduro's jib. And we've seen this happen several times now. What do you think of maybe Team Not West says, well, I think I'm going to allocate some of my reserves, foreign exchange reserves, into some other form of what wealth preservation. Usually it's U.S. Treasuries, and I think that's another. I'm again driving towards gold because I can't think of anything else. Where else you would put? I guess commodities. Where else would you put if you're on the other side of this focused? What am I looking for? What's the word I'm looking for? Attack, restriction, theft.
I think the dollar standard was based on the fact that the U.S. government was willing to make all of the global dollar's money good. Mm-hmm. And what's happened over the last it feels like months, but really it's just been 3 weeks now, is that the U.S. government, with the support of Europe and other Western allies, has broken that longstanding contract. Mm-hmm. And we're already seeing, just in the last few weeks, some of the especially smaller, more nimble central banks taking very strong action in response. So, for example, the Central Bank of Israel has begun to sell down its dollar reserves and diversify into euros, gold, etc. Obviously, Russia had taken steps to diversify their reserves in anticipation of this conflict. So they'd sold almost all of their treasuries over the last 5 or 6 years, and now hold a huge amount of gold and euros and other currencies. But I think there's very few options for another reserve currency besides the dollar. But I do agree that central banks are going to diversify into other areas, and gold and commodities seem like a natural place to place your funds because the value of those to your economy is virtually perpetual.
I had a great time, Adam. Unfortunately, we've run out of time. Ladies and gentlemen, if you've enjoyed this show, please reach out to Adam. You can reach out to the team as well. On email, you can reach out at moneysense@cndw.ky, and on Twitter at moneysenseradio. Adam, do you have some way of people to get in touch with you?
Yeah, you can go to investresolve.com and learn about our team and find my email and other contact information there.
All complaints, death threats, and ransom notes should be sent to me, however. You can do that at Emil Kalinowski on Twitter. And that's it, ladies and gentlemen. We'll be talking to you again in another fortnight. I hope you have a great rest of your day.
Thank you.
Money Sense is brought to you by the Chamber Pension Plan. For further information, visit chamberpension.ky.
The Cayman Islands Chamber of Commerce Pension Plan is kicking off the new year with a new website to better serve our members and a new administrator's agent that will help fulfill our vision for your pension plan. Our website, chamberpension.ky, features improved web services like a real-time chat to help answer your questions quicker and audio tips to help you plan for your retirement savings arrangement. Our new administrator's agent, Saxon Administration Limited, will benefit members through enhanced systems and IT services, allowing for a greater customer service experience. The Cayman Islands Chamber of Commerce Pension Plan. We're here for you. If you would like to join or request further information, visit chamberpension.ky. And for information as it happens, follow us on Facebook, LinkedIn, or Instagram. Email admin@pensions.ky